Stocks swing from green to red as mixed earnings and global cues muddy the outlook. Realty and FMCG lead gains while metals, consumer durables and healthcare drag.
Hindalco slips after its armed Novelis reports a big hit on profitability due to high costs, but Coal India perks up on a hefty dividend despite an earnings miss.
MRF slides on sharply lower margins and Dr. Lal's and Metropolis slip on fears of rising competition, while Jubilant Foodworks sulks as the non-pizza business disappoints, but PI Industries rallies as new brands kick up growth.
Paytm owner 197 Communications EBITDA loss contracts, sparking hopes of a turnaround, while lower loss and a visible path to profitability drive up Policy Bazaar owner PB Fintech.
Good afternoon, you're watching us here on Halftime Report. I'm Mangla Malu. With me is Ekta Batra as well as Sonal Bhutra. Well, we're looking at an absolutely flat market. This morning, of course, the Nifty bank hit a record high. The Nifty opened well, but in absence of any, clear directional cues, maybe the bulls thought they would wait and pause as we speak before a big next move that we see. But over the last few trading sessions, we've seen that, this is the time where the dips on our markets are being bought into. So it'll be interesting to see whether this one as well is bought into, and do we brace ourselves for a last hour rally or not. The mid caps absolutely flat. It's just the Nifty bank which is mildly in the green.
Hi guys, yes, absolutely. And one of the key things that I think I'm watching is the way the PSU bank index is probably going to perform on a week-to-date basis. It's already picked up around 7% on a week-to-date basis. We're seeing the banks see further momentum in today's trading session, with the bank Nifty managing to hold its head above the water. So in the past 7 days, as you can see, the Nifty PSU bank index itself has gained over 10%. Not so much in terms of luck for the Nifty bank, which is up around 1.3% on a week-to-date basis. So there's definitely a lot of momentum which continues for a lot of these PSU banks. But a lot more to watch out for. We have the US CPI data also, which is due tomorrow. So maybe there is consolidation ahead of that, considering that the Fed decision will be data dependent going forward.
Oh yes, a lot of cues we'll be watching out for. Since you guys spoke about the markets and what you're watching out for, just a couple of stocks in the broader markets which are reacting strongly to their earnings. PI Industries, something that we'll discuss in detail as well, strong set of numbers. But other than that, look at BLS International Services. It's up 9% on very strong set of numbers. On the flip side, we have NRB Bearings, a smaller stock, but it's down 15%. Also Lakshmi Organic, which is touching the lower circuit, down 5%. And we have Nitin Spinners as well, which has reacted negatively to the earnings. We'll discuss a lot of earnings through the course of the show, but let's start with the first management now. It was a mixed quarter for Cera Sanitaryware. Company's revenue growth for quarter 2 was muted, although there was margin expansion year-on-year basis. Stock is down 11% from its highs. Let's get in the management. Ayush Bagla, who's the executive director at the company, joining us now to discuss the earnings outlook as well. Ayush, good afternoon. Thanks a lot for joining us. Well, I wanted to understand about the outlook going forward. Your faucet capacity was to expand 2.5 times. How much of it has already happened, and what's the utilization? Additionally, what is the current share of revenues from faucets for you?
Thank you for having Cera Sanitaryware on your show. We had our best Q2 ever in the history of the company. And faucetware, the current plant is operating at 116% capacity. The demand far outstrips current production. So we did a lot of in-house moves to raise our productivity levels. We are making about almost 3 lakh pieces per month. That is being raised to 4 lakh pieces per month. And the capex has already commenced. Capex is about 69 crores, which will get completed by July 23.
And as far as the revenue of your different segments, all the segments, can you tell us, how much came in from sanitaryware this time? How did that vertical perform? Tiles, faucets, all of them, if you could give us a sense of the breakup of these revenues as well as margins.
Cera is primarily a sanitaryware company. 55% of its top line is from sanitaryware, about 33-34% is from faucetware. Wellness is about 2%, and tiles is about 19%. So 88% of our top line is from our core 2 categories of sanitaryware and faucetware, which are also the most profitable.
Right.
Okay, go ahead.
And what was the margin breakup across these segments? Just wanted to understand, primarily because, the last time you joined us, you did say that the raw material prices inflated by much higher than the price hikes that you took. Now that we've seen some cool off in important inputs like both brass and gas, Can you tell us what do you have in terms of margin outlook for this year?
We explained that our best case is that margins go up by about 75 basis per year on an annualized basis, and we are far exceeding that number currently. So the margin profile at the EBITDA level was always in the 12-13% category. This quarter, we've achieved almost 15.94%. And on an annualized basis, a similar margin is definitely possible. So as top line has grown from 1220 crores to 1440 last year, and this year the same trajectory can be expected. So the EBITDA margin should be upwards of 15%.
Okay, EBITDA margin should be upward of 15%. Can I probe you a little bit in terms of what you could do in terms of total revenue? Because in the first half, you've already done over 800 odd crores. Last year in FY22, you did over 1400 odd crores. Are you poised to probably double this revenue that you've done in the first half in the second half as well? And hence, we're assuming maybe over 1600 crores in terms of total sales for the fiscal. Is that a fair assumption?
The second H2 has about 55% of our total revenues. So based on that, we should comfortably cross your number. But we are very careful before giving out any guidance.
Okay. But if you could just give us a sense in terms of how demand is doing, because you did say you have some capex which is coming on stream as well. Give us a sense in terms of segment-wise capex, segment-wise demand, as well as what your assumption would be in terms of growth drivers as well, probably in the next year odd.
First of all, we are completely a B2C focused company. Sanitaryware and faucetware, home improvement, home upgradation are our major themes. So we have been very careful to steer away from interest rate sensitive such as new home loan sales and B2B businesses. So if you see the last 4 years trajectory, we have grown at 1.5 to 2 times the industry growth, both in faucetware and sanitaryware, which is 88% of our business. Going forward, that will continue to be the focus. Because of financial prudence, our cash in hand is now crossed 570 crores. Rating is AA by CARE and AA minus by CRISIL. We have zero debt on our books, either on the working capital or on a term basis. We have not utilized our A1 plus rating for our commercial paper program. All the capex is being done from annual operating cash flow, both the 69 crores for faucetware and the proposed 129 crores for sanitaryware. And on the margins, these two are the high margin businesses, and their growth, because of the nature of the industry, is so moated. The top 4 players continue to have more than 60-65% market share in sanitaryware, and we are the largest player in sanitaryware and the second largest in faucetware in the country right.
Ayush, just to follow up on the margin number, you had earlier indicating margins will be between 17 to 19%. Now you're saying it will be upwards of 15%. Are you lowering your guidance there?
The sanitaryware and faucetware business have a higher margin than the blended margin for the company. And on a particular quarter, including other income, just because of the size of treasury, you might get an upward spike, but on an annualized basis, a 15 plus number is the number we would like to have. And that margin growth was achieved both last year and the first 2 quarters of this year. 570
crores in terms of cash is what you have. Ayush, what do you plan to do with that for your investors? I mean, the capex that you have is just a little over 120 odd crores at best. The remainder, do you plan to give it out as, some dividends or maybe a buyback as well?
Actually, there's no discussion of a buyback on the table, Mangalam, but last year was the 40th year for the company, and there was a special dividend declared. So 46 crores was the dividend outgo. A novel dividend outgo annually has been around 20 crores. So being a financially very conservative company, we'd like to take very calibrated steps in that direction.
Okay. And any acquisitions which you would consider?
So we'd be very ready to consider any kind of acquisition in the sanitaryware business to acquire not a brand, but capacity. Because we feel that despite all the debottlenecking and expansion activities that we are currently undergoing, it's a matter of time that the company outgrows its current capacity.
Just quickly before we let you go, have you shifted from gas to propane? What's your fuel mix there?
Currently, we are on natural gas, and there's a reason for that. We have access to gas from Gas Authority of India in the district of Mehsana, which is at about 40-45% discount to market prices because these are from isolated wells in and around the factory, which are not connected to the national grid. So that is an inherent advantage of about 30-35 crores in costing that we get. Our gas cost till last year was about 13 rupees. Now it's about 25 rupees. In October, it's gone up to 33 rupees, compared to 75 to 80 rupees for the rest of the industry.
Okay. All right. So higher gas costs is definitely plaguing multiple industries across the board. But thanks very much for joining in and speaking to us. So that's Cera Sanitaryware. The stock is down around 4%, but they are positive in terms of growth as well as in terms of margins. It's definitely a play on the domestic growth story. And it is a cash-rich company with over 500 crores of cash on books. We need to take a short break. But up next, we'll be speaking to Vinati Organics, who's the MD at Vinati Organics, that company in focus on account of its Q2 numbers as well. Stay tuned. Welcome back. Well, for the markets, it's quite stable. The bank Nifty has come off the day's high, so it's just about flattened out, holding its head above the water with a gain of around 20 odd points. Let's discuss a couple of more companies which are in focus on account of their Q2 numbers. Vinati Organics is one such stock. In fact, the stock is up around 3 odd percent, reacting to its numbers. It's given returns of around 7 odd percent on a month-to-date basis as well. It was a good set of earnings for the second quarter. The company's revenue growth was strong, while the EBITDA per kilogram has also improved. Vinati Saraf, who's the managing director at Vinati Organics, joins in now to discuss the numbers. Vinati, hi, welcome to the show. I'm not going to try my hand at pronouncing the full form of all of the chemicals and the intermediates that you produce, but I'm going to ask you about the revenue growth of over 50% on a year-on-year basis. What was it led by, and what are you anticipating in terms of growth?
See, the demand for all our products, fortunately, is quite good. You have to understand we are into niche specialty chemical products, and they're sort of insulated, not entirely, but to a large extent, from the global scenarios. And you have to look at it very, piecemeal-wise. And so, for example, if you look at ATBS, that product is used in oil exploration. And the demand for that product has been quite good for the last 8-9 months. Similarly, our isobutyl benzene, which is used in ibuprofen, that was actually that product, the demand for ibuprofen was quite low last year. And that's why year on year, we've seen a very good growth in that business as well. Coming to our other products, such as isobutylene, that also it's used in agro, and that's doing fine. In fact, the sales of our new products, butyl phenols, which we were just entering into last year, sort of now we are more established in the market, and they have picked up as well. So that's basically the reason for the good growth year on year.
Okay. Vinati, good afternoon. You are sounding optimistic when it comes to higher demand, but I wanted to speak to you about your exposure to Europe and BASF in particular, because they have announced shutdowns, capacity has been hurt. In no way is that impacting demand for you, or will it impact demand in coming months or quarters?
Well, we are not anticipating any slowdown in the demand for our products. For example, we mostly supply to BASF in North America, and there we have not heard of any slowdown or any problems with their plants. We actually don't supply to them in Ludwigshafen. We supply to them in other locations. And, our product basket is diversified, our customer base is diversified. For us, the outlook remains positive for the next 6 months to a year.
Point. And as far as some of your own capacities are concerned, Viral Organics, that plant got commissioned this quarter. Just wanted to understand what the final capacity utilization is likely to be for this year. At peak, you had said this could do around 500 crores in terms of revenue for you. How much of that comes in this year? Next year, what do we expect?
Yeah, I think you're talking about Viral Additives.
Yeah, Viral Additives.
Yeah, that got commissioned, it's getting commissioned soon. This year, you won't see much revenue from that business since it just got commissioned. And there's a bit of a slowdown in that business, in the antioxidant business. But we do expect it picking up from April. We should also see capacity ramp up. Also, it's pending merger approval from NCLT. We hope the merger goes through by March and it starts adding revenue to Vinati Organics in FY24.
Okay. How is demand? I just wanted to circle back about the ibuprofen inputs that you do manufacture. How is demand and pricing looking within that segment? Because obviously, since COVID, we've seen ibuprofen demand hit quite badly because people were using paracetamol, there were inventory buildups, and hence ibuprofen prices were depressed. What is it looking like right now? Has it normalized entirely? And what does it mean in terms of inputs for you or input supplies by you?
No, I see ibuprofen demand and pricing going back to pre-COVID levels. Actually, just pre-COVID, there was an abnormally, good time for ibuprofen manufacturers because one of the plants was shut and there was a shortage, and so the prices had really skyrocketed. But what I'm seeing now is what was the situation historically over the last 10, 15 years. So I would say right now, ibuprofen demand price is back to what it should be. The last 4 years have sort of been an anomaly, first going very up and then going very down. Similarly, for IBB, it's a stable business for us. In fact, the share of IBB in our revenue had gone down to less than 10% last year. And this quarter, it was, it came up in the teens, somewhere around 15%, which means, that it is where it should be, and IBB is picked up as well.
Okay, so it is picking up across IBB and IB. Let's talk about butyl phenol then, because it's comparatively a newer product for you as well. But this quarter, it was hurt by some shutdowns. What is the current capacity utilization, and what are you expecting in terms of revenues this year and next year?
See, butyl phenols, we are currently running, I would say, around 60-65% capacity utilization, which is absolutely fine considering it's just our second year of operations. Maybe next year we should touch 80-85. The demand for most of them, we are the only manufacturer in India. So we definitely, have an edge over the imports, and we are making our mark in the market.
Yeah. Well,
yeah, go ahead.
About the other new products as well, MEHQ and you had Guaiacol, both of them potential 100 crore rupees worth business. Where do they stand at right now?
See, that's a new investment coming in Cera Organics, which is of Vinati Organics. That would take some time. It's still under construction. That plant for MEHQ, Guaiacol, isoamylene, and a few other products would take at least a year to come up and start running.
Okay. Okay, all right, Vinati, we're going to leave it on that note. It's a pleasure talking to you. Thanks very much for joining in and speaking with us. So strong performance, in fact, coming in from Vinati Organics. That stock is up around 3% I was reading a Nirmal Bang report which indicated that they believe it's one of the very few companies in their coverage where they see potential of 25% EBITDA CAGR in the next 5 years as well. So that stock up around 3%. We did have some numbers flash by. I think it was Godrej Properties. Maybe we'll just pull those up for you in just a bit. That should come up for you.
I think the P&L doesn't really matter. We'll have to look at the investor presentation and then we'll come back to you with what their sales performance has been this time in terms of net sales, collections and volumes as well. The stock is surged, but really P&L is just a basis of their accounting standards, which projects actually came in for accounting this quarter. So we'll look out for those numbers and we'll come back to you. But for now, we'll take a break. Up next, Aditya Agrawal of Way to Wealth Securities will join us for some trading strategies. Stay tuned. Welcome back. Still tuned into Halftime Report on CNBC-TV18. Well, it's a good time to get a technical check on the markets. Aditya Agrawal of Way to Wealth Securities is joining us now. Aditya, good afternoon. Thanks a lot for joining us. Well, it's volatile, but now in the red. What are the charts suggesting?
Good afternoon. Thanks for having on the show. Just a bit of a correction. It's not Way to Wealth Securities. It's Investor Edu. Nonetheless, I'll give an update. So markets have entered into a consolidation phase at the moment. Clearly, if you take a look at the way markets have been behaving. We open with a gap up, past 2 trading sessions has been like that, and then we just give up the gains, the morning gains, and kind of we slip into the red or maybe at the low point of the day. So all that suggests that there is a bit of a consolidation or maybe kind of resistances around 18,300, 18,350 on the upside. So clearly, that is the one area that traders should closely monitor between 18,300, 18,350. That happens to be the major hurdle at the moment, and markets are facing a bit of a hurdle and tough time to cross that immediately. On the downside, though, 18,000 to about 18,100 is your immediate support as well. So my sense is index could continue to consolidate in that narrow band between 18,100 on the downside and 18,300 on the upside. Both the Nifty and the Bank Nifty too is showing some sign of a fatigue and a profit booking around 41,800 to about 850. On the downside, 41,500 is your support area. So both the major indices could enter into a consolidation, while your stock-specific activity could continue like you're witnessing in PSU space. Suddenly today they're buzzing around and some of the metal names do look attractive. So you could see a bit of a shift in the sectoral move, but overall index could remain sideways.
Okay. And what are those individual stocks that you have for today?
Mangla, we've got a couple of buy recommendations. The first one that stands out is Voltas. If you take a look at the way the stock has performed, it's been corrected significantly while the markets continuously went up. Now, after this significant correction, it's come to a very close and a very important support zone as well. So at current levels, the risk to reward is in favor of going long on the stock. It's a low-hanging fruit. Maybe at current levels, one can look at going long. It's more of a positional trade. One can look at a target of 880-900 on the upside. On the downside, 820 to 810 is a very good support zone. So Voltas is something which is a contra trade at the moment. Second is Poly Medicure from the mid-cap space, which is doing phenomenally well. After a breakout, stock went into a lull phase, and again, past 2 trading sessions, we are seeing good volume-backed activity in the stock. So on the upside, stock can clearly test levels of 1100. On the downside, maybe 1050 will be a good stock.
Okay. All right, Aditya, we're going to leave it on that note. Thanks very much for joining in and speaking with us. Just want to point out Sun Pharma, because that one is now at the low point of the day. There was negative news where the Mohali unit, in fact, has received an official action indicated status from the US FDA. So that's the reason why you're seeing this subdued trade come in on Sun Pharma. Just want to point out it's been a rank outperformer. It's up 20% on a year-to-date basis. So maybe the street is not too stirred by the negative news on Sun. We need to take a short break. On the other side, we'll put more focus on some more stocks and news. Stay tuned. Welcome back. Well, one of the big cues to watch out for would be the US CPI data. So maybe we can just pull up the trend for you to see how exactly it's moved. For May of 2022, it was 8.6%. It peaked at 9.1% in the month of June. And since then, it has been on a decelerating level. So for the month of October, where the data is due tomorrow from the US, it is expected to come in at a sub 8% figure. 7.9% is what the street was anticipating or is anticipating. So let's see whether that comes through or not. Remember that the core CPI has been between 6.5 to 6.6% for the US, and that seems to be a point of worry as well. So the street will see for any kind of softening on the core CPI and not just the headline index. So that's the trajectory. 7.9% is what an estimated poll is in terms of US reports for the CPI data. But let's move on then. The new pollution norms have been notified by the Ministry of Environment and Forests, and the new rules impose tighter emission norms for DG sets with effect from the 1st of July 2023. Vivek Iyer joins in with the details and the likely impact. Vivek.
Well, that's right. So, along expected lines, along the lines of the draft electricity bill that has actually gone ahead and proposed very stringent norms as far as pollution emission is concerned for the usage of DG sets, which is diesel generator sets. Now, the latest notification has come in saying that these rules will now come into effect from 1st July of 2023. So what do these norms actually indicate? The rules prescribed limits for pollution via the particulate matter that is emitted by the usage of these DG sets. And what it actually does is, the final emission norms are largely in line with the draft emission norms, and these emission standards now places India at par with global standards, global developed markets. Now, when you're talking about these usage of DC sets, and when you're talking about Indian corporates who manufacture these DC sets, they'll largely be impacted. So Cummins India and Kirloskar Oil Engines are two companies within the Indian market that actually manufacture these sets. And Nomura, in fact, has written a note on this latest development and saying how it will impact Cummins India. So what they're saying is that the CPCB4 emission norms, which is the Central Pollution Control Board norms, which will come and which will be effective July 2023, may lead to an increase of almost 25 to 40% in rises as far as the end customer usage is concerned, given the fact that for companies like Cummins to go ahead and manufacture these little gensets, there will be an increase in the cost. So what they're saying is that the higher prices may impact the end user demand. However, there could be some pre-buying activity that could be seen till the first quarter of FY24. So they believe that a near-term spike could come in as far as ordering activity for diesel genset is concerned. However, they see a potential lull in demand for the next 12 to 18 months after these pollution norms come into effect. So Cummins India and Kirloskar Oil Engines definitely impacted on the back of these developments.
Okay, all right. Vivek, thank you so much for joining us with those details. By the way, Godrej Properties operational update is out, and we have quarter-on-quarter and a YOY decline on both their area sold and booking value as well. So their area sold, that is the volumes, they have declined 25% on a YOY basis. It's a 4% decline on a sequential basis. Similarly, booking value is down 6% on a YOY basis. It's a 4% decline on a sequential basis. Collections, although they have risen both on a YOY basis and on a quarter-on-quarter basis. Definitely, the street is not liking the fact that both their area sold and booking value have gone down. Not only that, at the same time, their debt has increased. Debt is at around 1,400 crore rupees versus 950 crore rupees on a quarter-on-quarter basis. There has been a continuous rise in their debt in last 3-4 quarters, and this is because of the big land acquisition spree that the company is on. So operational update is weak. The P&L impacted by the accounting standards, and debt also has risen. That's the reason it's a sharp knock on the stock, down 4%.
It'll be interesting to see, what happens from here on, because just a line on the management commentary, they're saying at the halfway mark, they're confident of achieving their booking value guidance of 10,000 crores for this year itself. So will the street take note of that, or perhaps, these operational weakness will weigh on the stock is something we will monitor. But as far as Coal India is concerned, that's doing well in today's trading session on account of the hefty dividend, despite an earnings miss. Nigel joins in with the fine print. Nigel.
Well, that's right. For Coal India, it seems the street has taken note of that hefty dividend and brushed aside the numbers, which were a little lower than what, most on the street expected. So on the top line, there was a small miss. The EBITDA number as well, a bit of a miss out there. And the profit number as well did miss estimates. And the key reason was the blended realization came in sub 1,800 rupees per ton, came at around 1,781 rupees per ton. Remember, most on the street were anticipating a number of around 1,850 to around 1,900 rupees per ton. So that was a bit of a miss. The key reason out there is the e-auction volumes. Well, that contributed less than 7% of their total sales. Remember, in the past, it contributed around 11, 12, 15%. Also, lower contribution coming in from the e-auction segment, which is the profitable part of their business, and realizations out there had spiked up big time. The other factor that played out was costs are higher. Employee cost was higher on a year-on-year as well as on a sequential basis. So we need to wait for management clarity as to how much of it was provisions for further wage rate, future wage hikes. That's going to be important. Besides that, you also had the stripping activity, which is a non-cash expenditure. That as well did spike up out there. However, though the numbers were weak, the dividend of around 15 rupees, that's something clearly that the street liked, explains why the stock is doing well.
Okay, that is about Coal India. But Nigel, Hindalco is losing in trade today. Novelis reported a big hit on profitability. Tell us more.
Well, Novelis's numbers were more or less in line. If you're looking at the absolute EBITDA or the EBITDA per ton, EBITDA per ton are around $515 per ton. Well, that's par for the course. The problem is that the near-term outlook could be muddled, because the management on the con call, they said that there are some cost headwinds which could pull back the EBITDA by around $75 to around $100 on a per ton basis. So basically now the street is staring at an EBITDA per ton number of around $420 to around $450 per ton. The longer term though, they are maintaining that trajectory of around $525 per ton, because they say those the costs will get adjusted accordingly, and that's why 2 quarters down the line profitability will be back. The other factors that did come out in the numbers were capex was pulled back. Remember earlier they were guiding for around $1.3 to $1.6 billion. Well, that's got pulled back to sub $1 billion, but some part of the street was already anticipating that. The net debt number continues to remain a little bit elevated. There was no reduction even on a sequential basis. However, in the second half of the year, the management is stating that the working capital will get released, which amounted to around $600 million. So that will be a bit of a relief, and that's why they're guiding for free cash flows of close to around $500 million for FY23. So they're expecting a big recovery in terms of cash flows. Back to you.
Okay, all right, Nigel. Thanks very much for that. So let's see whether that recovery does come through in terms of cash flows. Well, it's not only Hindalco which is losing out in trade. It is the diagnostic companies which are having an extremely rough ride. So if you look at the numbers weren't really bad in terms of a Q2 performance for both Dr. Lal's as well as Metropolis. Margins improved on a Q-on-Q basis. Margins for Dr. Lal's came in at around 27% versus around 23.4% Q-on-Q. Similarly, for Metropolis as well, margins improved to 26% versus around 24.5%. Non-COVID-19 revenue improved as well. Dr. Lal's was up 15% year-on-year. Metropolis, highest quarterly revenue in terms of non-COVID revenue, which is basically your bread and butter based business, because COVID-19 revenue is almost negligible for these companies now. But what feared the street, and that's the reason why you're seeing the stocks correct, is anticipated competition. Competition in the diagnostic space has increased, as we all know, manifold during COVID-19 from the likes of online aggregators, hospital chains, as well as pharma companies. The competition, in fact, has resulted in price erosion in key routine tests as well as wellness packages. Now, patient volumes, and brokerages are cautious on this. They are expecting it to slow. Estimates of patient volumes are expected to come down to around 6 to 8% on a 5-year basis, as compared to over 12 to 14% that they recorded in the previous 5 years. Margins are likely to move lower. That's because of lower test prices as well as marketing expenditure, and EPS estimates are expected to be just about 2 to 3% CAGR in the next 3 years, as compared to over 10% growth that we've seen historically. Valuation-wise, these stocks are expensive, so they've been given a premium. You expect that premium to probably shave off now on a 1-year basis. Silver lining, organized competition has probably improved quality in the sector. Some new entrants have now reduced that aggressive pricing that we've seen, simply because it's not sustainable in the long run. And new avenues of growth, preventive testing such as SwasthFit for Dr. Lal's, specialized testing, they've got into reproductive testing, expansion into tier 2 cities, mergers and acquisitions. So that's something to watch out for. In fact, we did speak to the CEO of Dr. Lal's, Pat Labs. Let's listen in to what he had to say.
We do believe that, a pre-COVID margin levels of 25-26%, normalized EBITDA margins are what we are really, keen to achieve, in spite of all the pressures which come into the business. So that is something which we are constantly working towards, on a longer term basis. And that is what we feel comfortable with. We have been tracking competitive pricing, and what we understand is that a lot of them were introductory or promotion prices, which are now slowly being withdrawn or moved upwards. We have seen evidence that the package prices or the one-off test prices, which were at a deep discount, are slowly being inched up to what we believe will be sustainable pricing for all the players. This industry has a very high gross margin contribution the way we look at it, but also a very heavy, what I would call fixed cost structure. So it is not really possible to keep offering very, very low prices without fundamentally altering the value chain of this business. In the absence of any value chain, all the promotional pricing will obviously move out over a period of time, and which is what we really are witnessing at this point of time.
All right, with that, let's take a short break. On the other side, we'll get some light on some more stocks which are reacting to their second quarter numbers, some brokerage upgrades and the likes. Just keep an eye out on Berger Paints. The stock's at the low point of trade, reports its numbers tomorrow, so maybe ahead of that, the street is positioning itself. Some weakness expected in Berger Paints, especially the margins, so keep an eye out on that one. But Paytm owner 197 Communications EBITDA loss contracts, as a result of which the stock's holding mildly in the green. Abhishek joins in with more.
To begin with, the revenues are ahead of our poll. They came in at 2,014 crores. We were working with a number of 1,842 crores. So the EBITDA losses have narrowed down to now about, 166 crores, which compares to about 275 crore in the previous quarter. Now, this is the adjusted EBITDA loss. So calculation shows that, the EBITDA loss ratio that I've calculated on the EBITDA loss by, revenues, that is now at 8.24% when compared to 15.44% in the previous quarter. So contributed profit have increased to about 843 crore, which is up 16% YOY and about more than 220% on a YOY basis. So contributed profit margins is now at 44.1% when compared to 24% in the same quarter last year and about 43.2% in the previous quarter. Net loss have come in at 572 crores. We are working with a number of 595 to 596 crores. Brokerages remain a mixed bag in terms of their recommendation on the stock. They say that the revenue broadly in line, but EBITDA losses are narrowing, which is a good point. Pre-IPO investor lock-in period ends on 15th November, so that needs to be seen. How the selling pressure comes in or does not come in, that needs to be seen. So solid operational performance, closure on IT audit that RBI had pointed out, that needs to be seen. Goldman Sachs says, they expect multiples to re-rate for Paytm from here onwards, given the fact that they have approached adjusted EBITDA break-even by mid-CY23. So across brokerages, you have a mixed bag in terms of recommendation. Target price ranging from as low as 450 per share to as high as 1,130 per share. Back to you.
Okay, all right, Abhishek, thank you so much for joining us with those details. Well, the stock on my radar is PI Industries. It is up 11% as we speak, and strong set of numbers that the company reported, and it has come in on a high base as well. So overall revenue growth of 31%, EBITDA growth of 49%, and this has led to operating profit margins increasing by 200 basis points and profits going up by 46%. Both the export and the domestic markets did well for the company. Export growth was 29%, and there the volume growth came in at 25%, so 4% was pricing growth, 36% growth in domestic markets, out of which 31% came in from volumes itself. Newly launched brands of the company, they contributed to significant revenue growth this time around, and the company goes on to say that the trend of rising input costs continued, but they have been able to pass it on to their customers during first half. EBITDA margin improved on account of better product mix and also operating leverage. They continue to hold that cash of 2,300 crore rupees in their books that they raised via QIP, and they continue to identify value-accretive inorganic growth opportunities, something that the company has been telling us for a long time, but a big beat there and on a high base, and that's what the street is liking today.
Okay, all right, so that's on PI Industries. Well, ironically, I was just looking at Divi's Labs. That stock hit a fresh 52-week high on the 9th of November 2021, and today it's sitting at a fresh 52-week low at 3,281. 52-week low was at around 3,275. So it's really been a turn in terms of sentiment when it comes to Divi's Labs. It's seeing a further downside in today's trading session after that cut that we saw on Monday's trade post its numbers. Brokerages seem to be quite negative or a little tentative on it. Jefferies, for example, has an underperform with a target price of 3,017 rupees. Q2 missed estimates. Custom synthesis sales continue to decline. They continue to believe Divi's growth levers will only kick in FY24 onwards. The near-term outlook remains uncertain. Motilal has downgraded the stock to neutral with a target price which is cut to around 3,250 rupees. They've cut the estimates by 18% for FY23, FY24, factoring in a deceleration in the custom synthesis business, moderation in the API business, delayed scale-up in the nutraceuticals business despite a capacity expansion. So that's the word coming in from Divi's. Brokerages seem to be quite negative. Those are the NALCO numbers for you. Net profit down around 77% on a year-on-year basis. Margins have come in lower on a year-on-year basis as well. So we'll get you more details on that. Net profit at around 170 crores versus our estimates of over 200 crores in terms of profit. So that too has missed estimates. Revenue down around 3% on a year-on-year basis, coming at just about shy of 3,500 crores. We'll do one thing. We'll get more details on NALCO, which has moved to the low point of the day. But as of now, we need to take a short break. On the other side, our commodities editor, Manisha Gupta, will be with us.
Welcome back. Still tuned into Halftime Report on CNBC-TV18. Well, Nalco's numbers, the stock is down around 2%, but from the Nifty pack, we have a couple of stocks which are at the day's high. We have ITC, which is surging. It's up around 1.5%, so that stock should come up for you on the screen. Reliance Industries is the other one, which is batting for the bulls. The stock is at the day's high, though sitting with gains of 0.4%. HDFC Bank is the other one, which is also at the day's high as we speak. And from the broader markets, we have these banking names which are doing really well. For instance, PNB is up 8.5%. We also have Union Bank, which is up 8% as we speak. So good going for the PSU banking names, and that is something we've been pointing out for some time now. But let's do one thing. Let's talk about commodities now. Manisha Gupta is joining us as always with a roundup of all that's happening in the commodity and currency market. Hey, Manisha.
Sonal, thank you so much for that. I'm looking at tea as a market because we have seen the prices on a weaker side as compared to the previous year. When you look at the export numbers as well, those while have been on the stronger side, but in the international markets, whether or not India has been able to be a beneficiary, what are the kind of supplies that we are seeing? For that conversation, we have with us Mr. Prabir Bhattacharjee. He's SG at the Tea Association of India. Mr. Bhattacharjee, welcome to the show. First of all, on the prices itself, how would you look back at the year?
The prices have been, there are the two divisions one has to look into. One is the orthodox variety and one is the CTC variety. Now, as you know very well, in India, the maximum quantity of the tea that is produced is the CTC variety. That will be 1340 million kgs odd. 110 million kgs will be orthodox. The rest is basically the CTC tea. Now, the prices of the CTC tea has been more or less at par with what it has been in the last year. But so far as the orthodox is concerned, it has been seeing a jump, a buoyancy for the current couple of months concerned, and it continues to be like that.
And what's your sense on demand going forward? I mean, what is the kind of supply that you're looking at and the demand too?
Yeah, again, I'll concentrate on orthodox because that's the only bright spot that we have got right at present. Now, you know all very well that Sri Lanka produces primarily orthodox teas. The yearly production is 300 million kgs, which it is estimated that it shall come down to 260 million kgs. Now, where does the orthodox to be supplied, to the world market, particularly Iran or UAE? This is where the government, where the India has stepped in, and they have increased quantitatively the export quantum that has been sent, particularly to one country, UAE. So till July, the figures, official figures that we have, they've already exported 23.84 million kgs to UAE. Now, this is where the prospect lies on the export front. And let me also add you one thing, Manish, over here. Let's see, if you look at the Department of Commerce figures, you'll find it out. There has been contractual export to somehow 4.85% in general. I'm talking about it.
Okay.
So therefore, the exports have not been as buoyant as it was expected to be over there. But still, we do expect that the tea exports should be ending around 225 million kgs for the year 2022, which was only 136 million kgs last year.
Okay. How has, as you said, the CTC prices really haven't done so much. We do know that input cost for all commodities has gone up. So as an industry, how have the higher input cost and the not so great tea prices worked for you?
Yes, Manisha, that's a very, you touched on a very sensitive and a very raw spot, because see, with the wages that have come up in the recent times, it has been substantive. There has been no corresponding rise in the fetchings that we have got from the market concerned. So the going is, very, very, very tough, no doubt for the tea industry concerned. And this is where the big producers, they are getting ahead. Now, you must also, Manisha, you're an expert on this line by this time, that the tea industry is sourced by two major resources. One is a big growth, one is a small growth.
Correct.
Now, what has happened is this, the last 2.5 decades, there has been a phenomenal rise of the small growth sector. So what is happening is this: the small growth sector is growing because their overheads are very little. The manner in which they operate, that is also radically different from what we do in the big growth.
Okay.
So the big growth are taking a hit. There's no two doubts about that.
Clearly. Yeah. So, a couple of more numbers that I'm looking forward to from you, Mr. Bhattacharjee, is one on what is the kind of demand growth that you're working with right now, and two, what is your sense on prices going forward?
again, I'll come back to the orthodox part. So where the orthodox prices are concerned, I think it will hold on till June 2023. And then the reason why, because there is a shortfall of production of 40-45 million kgs of orthodox teas. So obviously this is being filled up by the orthodox production of this country. So we do feel that till June 2023, the prices of the orthodox will hold down. So that's an encouraging sign for the tea industry concerned. Now you might ask, why I'm talking about June 23. It is so because the Sri Lanka is now catching up with the lost production in the sense that they have now access to better quantity of fertilizer and other factors that have crept in. So we do feel that with the stock that is there, we should be able to hold on to the orthodox prices till the June 2023. So as the CTC prices are concerned, as I told you, there has been no appreciable movement of the prices concerned. And it is indeed a very worrisome aspect for the organized tea industry.
Okay, so if you're a producer of orthodox tea, then clearly until June 2023, there's laughing your way to the bank, but not for the CTC producers.
Okay, all right. Manisha, we're going to leave it on that note. Thanks very much for joining in, taking us through what you're tracking in the commodity space. Well, for the markets, it's quite flat at this point in time, just about tentative ahead of that big US CPI data and what the Fed's next steps could be. As of now, Hindalco is your top loser on the Nifty, followed by the likes of Divi's, and Adani Ports is your top gain on the Nifty, up around 5%. It's a wrap on Halftime Report. Business Lunch up next. Stay tuned.